Assalamualaikum warahmatullahi wabarakatuh. We are from Group 2 and we're presenting about audit of cash. My name is Hasni Falina binti Abdul Qadir with metric number of 281473. I will start the presentation with introduction of audit of cash. The aim of our cash audit is any transactions of cash incurred within the organization in regards of starting and ending date of accounting period. Cash cycle in auditing can be contemplated as full or partial analysis in accordance with the evaluation had been carried out, whether using sample transactions or every transactions occurred. Cash cycle are generally embedded to ensure the accuracy of cash deposit and cash balance and to ensure entities had established a genuine cash documentation according to GAAP. The motive is to prevent a fraud or material misstatement in cash flows. Thus, it shall assist auditors in detecting a fraud case known as lapping. Lapping is a financial crime which often occurred when an account was amended by workers in charge. Next, we move to audit and control objective. The main intention is to verifying balances in cash account at the end of accounting period with transactions occurred for represented year. Next is to determine whether the transaction of cash is recorded accordingly and to ensure all of the cash balances are adequately classified and disclosed with correct amount in financial statements. Next, to take into account any inherent risk corresponding with recorded cash. It may caused by any omission or error in cash flows regarding other failures such as fraud. Thus, it also helps auditor to prevent any material misstatement that could affect financial statement and other assertions. If there were any material misstatement arise, it will inhibit the auditor from producing a valid audit report of one's entity. We are now moving to transaction objectives. Transaction assertions were first developed by IFRS through ISA 315, which indicates that risk of material misstatements can be identified and evaluated through the comprehension of the organization as well as its environment. Auditors often implement these assertions to ensure the authentication of the financial records and disclosures generated. When all the assertions were concentrated, this indicates that all of the transactions occurred and calculated balances were appropriately documented. Transaction assertions works as one of the management assertions to investigate any fraudulent or material misstatement incurred within organizations. Next, we'll look at the elements of transaction assertions. There were 5 elements under transaction assertions. First is occurrence. In case of occurrence of business transactions, it is advised to document the transactions at the time of its occurs. This is to avoid any procrastination at all costs, as it can lead to any misstatement for the organization. Hence, the summaries of transaction in financial statements corresponds to the actual events. Secondly, completeness. The financial statements actually contain all transactions that ought to have been reported. That is accuracy. In any transactions recorded, it is very crucial for the executive to ensure that the recorded amount were correct and error-free. Amount and other information related to the transaction and events that have been properly recorded, as well as related disclosures, have been measured and documented. Fourth is cut off. Ensure any business transaction recorded must on that occurred within the correct reporting period. If the transactions occurred outside of the accounting period, a reconciliation in financial statement is needed. Thus, every transaction should be included in appropriate year. Lastly, classification. During recording business transaction, it is important to ensure that the transactions were recorded under correct amount in general ledger. Thus, in financial statements and disclosures, all of the business transactions were also appropriately presented. That's all from me. I will pass to the next presenter.
Now we move to the balance objectives, which balance assertion apply to the balance sheet items such as asset, liability, and shareholder equity. There are 4 balance objective assertion, which is existence, right and obligation, completeness, and evaluation and allocation. The existence is the cash balance that shown at the end of the reporting period. Meanwhile, the right hand obligation is the entity that has the legal tie to the cash balance shown at the end of the reporting period. The completeness is the record cash balance that include the effect of all cash transactions that have occurred, and the valuation and allocation are recorded of cash balance that are realizable at the amount that been stated on the balance sheet and agree with the supporting schedule. Next is the presentation and objective, which is assertion that all appropriate information are included in the company statement, and all information presented in the financial statement is fair and easy to understand. There are 4 types of presentation and objective assertion, which is occurrence, right, and obligation, such as line of credit, loan guarantees, and other restrictions on cash balance sheet. Next is completeness, where the cash balance are properly identified and classified in the balance sheet. Next is classification and understandability, which is cash balance is appropriate presented and information disclosed are clearly expressed. And lastly is the accuracy and valuation, which is the cash balance are disclosed accurately and appropriate amount. Given the unusually high risk of fraud associated with cash, the company must need a large number of control. The auditor may also want to conduct a lot of tests of control by tracing a selection of cash receipt and disbursement through the business to see if the control were properly applied on each step in the relevant process. There are few relevant control that can be done, such as firstly in the accepting the cash. For the first step is in the opening the mail and record the cash receipt. There should be 2 persons to open the mail jointly, so the chance to be fraud happen is low. Next is in the endorse for deposit only, which the person that already opened the mail endorse all of the check to ensure it difficult to someone else to extract the check. Next is to record the cash in the cash register and record the cash in pre-number receipt to ensure that there are no missing receipt. And lastly is to give receipt to the customer and match cash register to the receipt, which they ensure that the cash in the register match with the amount that be stated in the receipt. Next, in the recording cash, firstly is to apply cash at once, which as soon as the cash received, the cashier should apply it to the customer account. Next is to apply cash based on the check copies and record undocumented receipt in the clearing account, which this will have this receipt always be recorded into clearing account for the subsequent inspection. Lastly is to match document, which is the cashier should compare the initial checklist generated by the individual opening the mail to the associate cash receipt notebook. Lastly, we move to the deposit of cash. First is deposit daily, which is can reduce the check or money to be stolen if being left on site overnight. Next is to match the cash receipt journal to the bank receipt, which they can ensure that the amount on the bank same as the be stated on the deposit cash. If the number doesn't match, it's possible that individual delivering the cash to some cash, or the possible that cash at the bank into the amount of cash wrongly. Lastly is to destroy the scanned check, such as destroy the scanned check or disfigure the check to the point that the check cannot be deposited. That's all. Thank you.
Assalamualaikum and hi, my name is Nufara Koyum binti Muhammad Suhaili. My metric number is 280853. I will present about developing the audit plan. It is essential to assess the efficiency of control measure intended to guarantee that balances are accurately reported to developing the audit strategy. Before determining element relevant to the efficiency strategy for auditing cash, materiality and risk are taken into account. There are 3 developing the audit plan that I will present. First, cash of safekeeping, which is the phrase safekeeping refers to a financial institution's obligation to maintain a client asset in a secure locations. For example, the bank will keep the money in safety when a customer places money in a certificate of deposit. However, unlike a bank which is free to utilize the cash on deposit to provide loans, stockbrokers are not permitted to use this asset to create their own profits. Without the assurance of safety, customers would not risk allowing a financial institutions to hold on to their investment. Second, Bank of Reconciliation statement. Bank reconciliation is the process to compare the record to those of bank. In order to determine whether there are any differences between these 2 sets of data for cash transaction, it is to determine whether every client cash receipt have been deposited, whether all bank deposit have been recorded, and also whether bank has paid every client payment. There are three key terms, which are deposit in transit, outstanding check, which is the check payment that issuing entity has recorded but has not yet been debited for cash in bank account. Lastly, not sufficient fund. Check was rejected by bank because insufficient money. The important bank reconciliation are to guarantee that the money entering or leaving an account at the end of each quarter equal the money actually spent, spot any unusual transaction brought on by fraud or accounting error. Now, unprecedented checks that have not been handed to the bank are referred to as unprecedented checks, despite the fact that the company has drafted it and recorded it in the books. The items are entered on the credit side of the cash book and had not yet been entered in the bank record. Unprecedented check at the end of 1 month may be presented during the next month. That's all from me. Thank you.
My name is Muhammad Danish Irfan bin Muhammad Nasruddin and my matric number is 280921. I will be explaining about uncredited deposits. Uncredited deposits are funds that are at the company's hands but have not yet been acknowledged by the bank. It takes the form of checks that consumers and clients deposit. For the auditors, they should consider doing two things. The first thing is choosing uncredited deposits from the bank reconciliation and trace to the following bank statement. The second thing is to identify deposits that were made before that date and then check the bank reconciliation. Next is about Impress accounts. Impress accounts is a system known as an Impress Petty Cash system. It involves transferring or reserving a set amount to a petty cash box, which will be replenished if it is spent. Plus, a fixed sum of money is set aside in an Impress account specifically for handling small payments. These accounts also keep a specific amount of cash on hand that can be used to pay for small expenses and compensate employees. So as a result, Impress often distribute the same amount of money on a regular basis, bringing the account's balance as close to a zero as possible before it is automatically filled off with the same fixed amount of money. Now we are going to look through the 7 steps that is consisted in the Impress Petty Cash Fund. The first is the fund should always be kept at the Impress level. It means that the sum of the cash in the fund and the payment vouchers should always match the Impress amount. Second, a single person should have custody of the fund. Third, when not in use, the fund should be kept secure and placed in a safe. Next, the fund should only make tiny payments and each payment should be accompanied by supporting documents. The fund also must not be mixed with other currency. Plus, replenishment must be based on an examination of the supporting papers. Last but not least, after payment, the supporting documents must be stamped to prevent reuse. Materiality and risk. Cash flow is crucial because it makes it possible for you to both fulfill your current financial responsibilities and make plans for the future. A company's ability to create enough cash from its operation is essential to its ability to pay its bill, pay back investors, and expand. The level to which an item or inaccuracy is considered important depends on the specifics surrounding its omission or misstatement, which determines its materiality. When compared to its balance, cash has a higher materiality than any other account balance. Each and every business operation and accounting transaction has an impact on the cash account. In order to handle a fully developed balance sheet together with an income statement and cash flow statement, double entry bookkeeping requires that 2 entries be recorded with each transaction. That's all from me, and I would like to pass to the next presenter. Thank you.
Hello everyone, my name is Intan Nazira Huda binti Zakir. My matric number 280899. There are 5 benefits why cash inflow and cash outflow should be balanced. First, performance appraisal. By calculating the ratio between the actual cash flow statement and the projected cash flow statement. If negative, organizations need to correct the errors in order to improve operational performance. Second, analysis of the financial position of the organization. It shows liquidity and profitability to analyze financial status. It also helps to detect cash deficit and ability to pay off its debt. Third, aspect of management of cash. organization may manage cash more effectively and determine the profit and loss incurred throughout the specific financial year with the help of a better understanding of cash inflow and cash outflow. Next, give effect in better planning. The organization can plan investment, allocate earnings and make other decisions connected to the operation. Last is better budgeting decision. Every firm needs a budget, whether it is an annual or quarterly. The budget of the organization is set based on the cash flow or the cash coming in and going out of that organization. Audit strategy approach is usually substantive. The main procedures for cash balance are to audit the bank reconciliation and reconcile the balance to the bank confirmation. Cash in area that is more susceptible to fraud than other areas. Fraud have two types. First, kitting. Kitting is fraudulent use of a financial instrument to obtain additional credit that is not authorized. Second is lapping. Lapping occurs when an employee alters account receivable record in order to hide the theft of cash. Substantive procedure. The goal of substantive procedures is to produce information that an auditor can use to assemble that the client's financial record and complete, valid and accurate, and that no material misstatement have been made. There are 9 substantive procedures. First, obtain balance detail. Discover each cash accounts and cash balance information, then compare it to the general ledger. Second, confirm balance. Send confirmation form to the financial institution requesting account balance verification. And the confirmations cannot be forwarded back through the client because the client would then have the chance to alter the information in the confirmations or to create fake confirmation responses. Instead, they must be received directly by the auditor. Third, reconcile accounts. Due to cash in transit or transaction that were recorded by one party but not the other, a client's cash balance almost never exactly match the cash balance reported by its financial institution. Therefore, as of the balance sheet date, the client will need to create a bank reconciliation. Next, examine cut-off. To ensure that the client has properly cut off the recording of cash receipt and cash disbursement, obtain a cut-off bank statement that details transactions that occurred after the balance sheet date. Other than that, count cash which verify the amount of cash on hand and review bank transfer. Examine any bank transfers for 1 week on both sides of the balance sheet date to ensure that there are enough funds on hand for the impending issuance of payroll checks. The second last is conduct analytical procedure. Compare the client's cash total to its operational information to see if there are any disparities worth discussing. Lastly, review presentation. Examine how the client has presented information in its financial statement about cash, including any disclosures in the notes that go with the statement.